So this is a conversation that is applicable probably to every single person listening right now. So you better pay attention here. And we haven't talked about this concept ever and after doing about 120 podcast episodes. So this is extremely important. I'm very excited to talk about this concept here. So if you have any business at all or a W-2 and have any intention to ever retire or even take this benefit, this is going to be applicable to you. We are going to be talking about Social Security today. And what is it? And how could you potentially benefit? What decisions are we going to make around it? And what is going on in the country? And what is this thing called Social Security? And how does it, and most importantly, we're going to discuss how does this apply to you? And how can we make strategic decisions to optimize your situation, whether it relates to collecting the maximum amount of benefits from your Social Security or reducing your taxes as well, as we talk about a lot. So all these factors have to be considered in this highly intricate topic. So I'm very grateful to be joined by someone who knows a lot more than me on this topic today, which is Mike Skrynecki. Did I say it right?
Say it fast, Skrynecki, and you're good.
Skrynecki, who I've known for a while in Atlanta. Mike, can you introduce yourself to the audience, and then we'll get into the conversation?
Sure, certainly. Thank you first off for having me. And this is an area that I'm Mike Skrynecki, the Skrynecki Financial Planning Group. This is an area I've been studying probably since before the turn of the century, when I had the good fortune to be a part of the local Atlanta Kiwanis Club with David Walker, who had went on to become the Comptroller General of the U.S. government. So we've been studying and talking about Social Security for the last 30 years. You may have heard that the trust fund is, a little wobbly these days, right? So there's a lot of concerns, and the number one question I help clients on a day-to-day basis optimize their Social Security, and the number one question that I'm getting today is, will it be there, right? Mark, despite what we think, there's 70 million people currently on Social Security, benefiting from it. And as you said earlier, we're all going to benefit from it at some point in time. We hope, fingers crossed, right? So most Americans rely on Social Security. It is a big part of their retirement. You may have heard of the three-legged stool, right? Most people don't have a pension anymore, so we're relying on two different legs of that stool. The average American has only about $51,000 in non-retiree savings, $126,000 or so for couples. So that personal savings leg is pretty rickety too. So there are a vast majority of people who expect to rely on Social Security. In fact, 69% of people expect to rely on Social Security, a third of whom Social Security will be their primary source of retirement income. So, and that number gets even worse for women who save less than men on average. When right now, almost 60% of women rely on Social Security as their only source of income in retirement. So this is a critical topic. And as I mentioned, everybody is going to benefit from it at some point in time.
Yeah. Before I jump into the questions here, we've spent a lot of time talking about mitigating your FICA tax, which is 15.3% tax on your first, in 2025, your first $176,000. And there's a lot of people, when they think about Social Security, when we think about planning, we're always thinking about how can we reduce or avoid it. But at the same time, it's not the worst tax, because unlike federal tax, when you pay Social Security, you're paying into a future benefit. So when we're reducing our Social Security tax payments, there's a trade-off. And that trade-off, how much of a trade-off or benefit you're losing varies depending on how much income you make. There's all these moving pieces. But if you're collecting a W-2, a lot of times, especially when you get that first W-2 paycheck out of college, you're always surprised to see how much money comes out because so much of it goes to your Social Security tax and your Medicare. And when you first become a business owner and you're just a sole proprietor, I call it the silent killer of entrepreneurs because your FICA taxes, you don't get that standard deduction. So let's say you make just over your standard deduction, you're thinking, oh man, I probably am going to pay absolutely no taxes at all. And then you get hit, your FICA tax, that Social Security tax, is in some circumstances greater than your federal taxes or your state taxes combined when you're starting off. So it's a significant tax to budget for. But what we're going to talk today is not so much about the mitigation. We'll talk a little bit about how that fits into the puzzle, but we're going to learn a little more about what this is and what it means to you here. So first question I have is, what does it mean to for Social Security? You may have heard go broke or become insolvent in the world of Social Security. And how do we get here? What's going on with that?
Yeah, that's a good question. And your point is well taken. There are the FICA tax that you're paying into the Social Security system is actually one, I just want to emphasize, one that you will actually get something back. So it's unlike your income taxes that go into the general government bucket to do with whatever they do with it, right? The benefits that you're paying into Social Security, you will actually get more out of that than you're paying in. And we'll get into those in more depth and how that goes. But the thing about Social Security, the Social Security system is actually made up of, and if you looked at the numbers, it's OASDI. It stands for Old Age, Survivor, and Disability. Okay, so you've heard that there's a probability of the Social Security trust going broke in 2034. Okay, well, there's a little bit of clarity that needs to be there. There are actually two trusts, one for the old age and survivor benefits, right? Those are the retirement benefits that we all get. And then there's the disability. If you are disabled and no longer able to work, you're eligible for government benefits for that. That trust is a little bit in better stance. But so what would happen when that trust runs dry? Okay, that doesn't mean there's no more money left, because the way the system works, those payroll taxes, those FICA taxes that Mark is talking about, those are going in to pay not for your benefit, but for the people who are collecting benefits currently, right? So we're paying in a benefit, and everybody, all those 70 million people who are taking out of it are coming, their benefits are coming mostly from those payroll taxes. Okay. The trust is the added extra amount, right? So right now, the benefits that are being paid out exceed the number of dollars that are coming into as that payroll taxes are collected. So that's what we mean when the trust fund runs dry. What that means is the payroll taxes will no longer cover all of the benefits that are due, so to speak. So in 2034, the estimate is that those payroll tax revenue that's being collected will only be sufficient to cover about 81% of the scheduled benefits. So what would happen?
Scary.
Yeah, what would happen? Benefits, will likely to be paid, but if there's nothing, if Congress doesn't act before 2034, you might get 80 cents of what you were expecting, or you might be delayed. There may be some delays. We don't know. We've never crossed that bridge.
What do you think is going to happen? What are they talking about? What could be discussed here?
Well, before we get there, let's talk about the most recent tax law changes, and then I'm going to kind of get to that, some possible solutions. But the original deadline, or the original kind of go broke, or that target, was 2034. Well, you may have heard the one big beautiful bill. A lot of people say, well, we've cut taxes on Social Security. Well, that is not true. Okay. What the one big beautiful bill did was provide for the next 4 years, this year included, a senior extra deduction, a below the line deduction. If you're 65 or more, you get a $6,000 deduction that does not offset Social Security. I'll give you a couple of examples here. If you are over 65, but not yet collecting, which a lot of our clients, I try to encourage clients to delay when they can, taking Social Security so that you get more income over your lifetime. If you're not collecting, you are eligible for that deduction. But let's say on the other hand, and most Americans start collecting and claiming Social Security as early as they are eligible, which is 62. They're not yet 65. So they may be collecting Social Security, but not yet eligible for that deduction. So they're not being offset. They're not benefiting from that deduction. The net result of that bill is that it has pulled forward that original target of 2034. Now the estimate is that the trust funds will run dry in 2033 or 2032. And that savings, if a couple is now again over 65, they may get a short-term kind of relief from this bill, a couple $1,000s, but long-term, the impact is estimated to cost a couple up to about $18,000 for the rest of their lives. So be careful what you wish for. It's a great golden opportunity now. I encourage you to, if you have any clients or anybody who's over 65, take advantage of those deductions. But you might want to put that money aside and invest it. Don't go on, trip around the world on those couple $1,000s you might save today.
Yeah, I notice a lot of these things in the big, beautiful bill. It looks really exciting, but then when you read the fine print, it's not as exciting. A lot of it's getting phased out. And then for Social Security, it's not reducing your Social Security taxes at all. Like if you had the opportunity to not pay taxes on your tips, well, it's a below the line. So you're still paying your FICA on all that tip money.
Yep. So what you asked, what are some possibilities? Let's look back to the last time we were facing a crisis like this. And that was the last time there were major adjustments to the Social Security system was 1983. Okay, at that point in time, and again, at the very last minute, Congress acted. So I expect very similar. We're not going to see any real motion until you've heard it takes an act of Congress to make changes, and that's exactly what it is. The president did not have authority to eliminate the tax on Social Security. That was implemented as part of the changes in 1983. Okay, what else was changed at that point in time was it also raised the full retirement age. So if you were born in 1960 or later, your full retirement age is now 67. Okay. And that was phased in. So, for most people who are retiring and beginning to retire now, the full retirement age is now 67. That is when you can get your full retirement benefit. If you apply earlier, you're going to get a permanent reduction. If you delay beyond 67, you can go all the way to age 70. You get a bonus of 8%. The government encourages you to delay where they can. So, one of the solutions that I think is that you might see something very similar to that, where, maybe you and I or people listening in today, they're a pretty important voting block. But my kid, who is not yet 18, doesn't have a say in this. Chances are he'll have to work a little bit longer. I think that's just one of my beliefs. But there are other options, and I'm glad to go into a lot of different potential solutions that are being bandied about.
Again, because people are living longer. Like my grandma lived to 95. When they designed this program, they didn't expect people to live on Social Security for 30 years. So I imagine
that is true. And the numbers are a play a role in this game. And think about, remember I said it's dollar in, dollar out. So what you have right now is the largest generation ever retiring at 11,000 people a day, the baby boomer generation, right? The Generation X is a smaller generation, but the millennials actually are as big as the baby boomers. The numbers will start to kind of even out. So this is not a demographic problem. It is more of a payroll tax problem. Remember, I told you at 2034, the payroll taxes are not going to be enough to sustain that fact that people are living longer and more people are taking benefits, right? So there has not been a payroll tax increase since 1990. So when they did this in 1990, they were estimating that the payroll taxes would cover 90% of the costs. Okay, so how did we get here? Currently, the payroll that they're bringing in, remember I told you, is only about 80% of the costs, right? So that is one of the big issues that are in play here. It's not that it has, it's just never, the system itself has never been fully funded. And yes, the numbers are getting out of whack, but the biggest culprit here is that payroll tax not being sufficient enough to cover the benefits promised.
So I know you talked about them raising the retirement age, and to my understanding, that original age of 65 was because that's when most people died. So the expectation was most people wouldn't really live to get their payroll tax. And obviously that's not the case at all. Like with my granny living on 30 years of that sucker. So what we're talking about raising so you talked about there's a possibility of them raising it. You think they're going to raise the payroll taxes as well as the retirement age? Do you think that's a possibility?
Well, I think the solutions kind of fall in one of two buckets. One is revenue raising. That is an obvious area. The other are benefit reduction. So let's broach the first one first. So right now, as you know, there is a cap on who's that payroll, right? At $176,100. If you make $1 more than that, anything over $176,100, you stop paying into the system. Okay, so a lot of the proposals, and I'll go into one most recent one here, are, well, what if we raise that cap? Now, back in 1983, that number was set, and it does increase every year. Okay, so it is an increasing number every year, but it stops particularly the higher end earners are no longer paying into the system. So let's think about this for a second. What is 6.2%? That's what you and I would pay in at that cap. How much would we pay? How much is the max any one person can pay into the system in a given year? 6.2% of 176,000 is just under $11,000.
Yeah, it's not a lot. And you have folks, you have physicians, you have high W-2s, and the W-2, if we have business owners, a lot of them have S corps where they're not paying nearly as much payroll. But the W-2 income earners are the ones who are really going to feel this payroll tax.
Well, yes, if it gets increased. But think about this. This is the misnomer. Well, I paid in, it's my money, I earned it, right?
Yeah.
Okay, maybe some, right? The max that any one person can pay in a given year is $11,000. You know what the max benefit is right now for those high earners?
I don't know.
It's about $4,000 a month. So they're getting 4 times what they've put into it. Right.
That's not bad.
So you can see that, like I said earlier, there are some good taxes, right? This is the lesser of two evil taxes, right? Because this is money you will eventually get back. Okay. So it's not the worst tax to have out there. Right.
We have a lot of clients in Tennessee, and there's this Tennessee franchise and excise tax. And you pay this Tennessee tax if you want to have an S corp. So a lot of people, they want to follow the masses and go by what they hear online, saying if you have income over a certain amount, S corp. And I'm telling them, listen, this is going to increase your Tennessee tax. I would rather pay Social Security taxes. At least you're paying into something you'll get back, as opposed to paying the state of Tennessee, and you don't know what they're going to do with your money, but it's not going to come back to you in any form of a benefit. So when we do our entity elections, especially in Tennessee, this becomes a really prevalent conversation on the different types of taxes and which one would you rather pay.
Yeah, and Mark, we talk a lot to particularly sole proprietors and people who can defer more of that income, right? Especially people who don't have any employees. That which tax, pay yourself more, right? Pay more, into the system here, and defer more of your other income, right? So you're paying yourself now and later.
Yeah, and
in that situation.
And now this is a little going to be over the heads of most of our audience, but there are instances where you pay yourself more of a salary and it gives you more of a wage deduction. And that also gives you, in some circumstances, as an entity owner, more qualified business income tax deduction.
Right.
And that kind of offsets a lot of the increase in the payroll taxes. And now you're paying, you're reducing your federal taxes, but you're increasing your Social Security tax, which is a payment into a future benefit. And then you can defer more with all these other strategies as well.
Yeah, you got to be real careful too. The OBBA also sets up some phase outs in some other areas. So that QBI, you want to bump that up at to certain levels, because then you start losing salt, and that's another topic for another day. But
there are many layers to this. But so
let's talk a little bit more about raising the cap, because that is, you may have heard in the last administration they said, all right, right now it stops at 176. But that's a number that goes up every year. So their proposal was, let's start it again at 400,000, and eventually that donut hole will close on itself. There is a current proposal in the that was just put in by I think Senator Gallego from Arizona. It's called the "You Earn It, You Keep It" proposal, right? And this is a way to potentially eliminate that tax on federal Social Security. So I think that was one of the issues that people are, again, one of the misnomers. Back in 1983, they created the tax on Social Security as a way to help kind of fill that gap, to bring monies into the coffer to pay those benefits. The problem with that was that when they set the numbers, the dollar amounts at the time, they did not index those for inflation. So it was designed initially to hit the top wage earners. Only the top wage earners or top retirees, the people making the most money in retiree, would pay tax on their Social Security. But because that wasn't indexed for inflation, it's now hitting pretty much everybody. Okay, so one of the solutions that I think, and you mentioned Tennessee, Senator Blackburn from Tennessee proposed raising that cap and indexing that for inflation, which I think would be a smarter move. Now, again, that doesn't solve the solution. So Senator Gallego from Arizona has proposed, well, let's get rid of all that tax, but raise the cap, right, to $250,000. Okay, so that is one proposal that's in the House right now, or in the Senate, I should say, right now. That would help pay for the no tax on Social Security, but it wouldn't solve the problem permanently. The estimate there would be, it would run it from 2034 to 2058. So again, that's a Band-Aid on the system. And then, you're going to run into, anytime you talk about raising taxes, you're going to run into problems from not only Republicans, but business owners who are footing half of that bill, right? So while it sounds good, I think it's a step. Those are all steps in the ultimate direction in which we probably want to head.
Yeah. So if you're a single member S corp owner, and we see a lot of those, you probably have some control over what your payroll taxes are going to be. You have to be in compliance with what you pay yourself. It has to be reasonable. If you are a W-2 income earner, you have zero planning opportunities to really impact your payroll taxes, unless you have some way to control what your salary is going to be. It's unlikely you're going to get to do much here. So you would feel that increase, right? But if you have a staff, if you have lots of employees on payroll, you're paying for half of those payroll benefits. So if you have folks making above that threshold and now you got to shell out more payroll taxes, you might be feeling it. But I think the employees here are going to be really, and the people who have lots of employees that are making high income, these are the ones I'm thinking that'll really feel this if it were to go up to that amount.
Okay. All right, so those are the kind of I told you there were two buckets, right? One is to raise revenues. That's always part of the solution. The other is to reduce the benefits. I think those are the ones that are going to probably hit the biggest walls, to be honest with you. Except for the reality there are the people who don't have a vote. I think the likelihood of the full retirement age being raised, it will be phased in more than likely, and it will hit, those who are, aren't, a part of a big voting block. I think they're the most susceptible. There's another thought process here too, because right now Social Security is one of the few inflation protected benefits that you can have going into retirement, because there is a cost of living adjustment every year. Okay. Mm-hmm. The cost of living adjustment, however, is based on the average wage index, which, as a retiree really isn't very relevant, right? So they could change how they peg that cost of living to something lower that would help balance the numbers. And quite honestly, I think that right now, what shouldn't be the CPI, but the CPIE, which for retirees matters more, right? It's going to take into account the things that retirees spend more money on, healthcare, for instance, which is, as we all know, is going up at a much higher rate than, this, cost of housing and, things that we all have to deal with on a day in and day out basis. But, I will caution this. I said, no matter what solution, the people who are out there now, the people who are on Social Security or approaching Social Security, I think that's a pretty powerful voting block. I don't think that any changes they do will probably be like when they did in 1983. Well, I'm going the wrong way here. 1983, when they grandfathered in and they phased in a lot of these solutions.
Gotcha. So, there's so many different outcomes or combinations of things that could potentially take place here. And, for anyone listening, even if you're a W-2, you can't really control much on how much of your income goes to payroll and your Social Security benefits. One area that will require and it opens the opportunity for planning is, when do we claim? And, as you mentioned earlier, if you claim it earlier, you lose benefits, but then you have it longer. And we don't know when we're going to die. So help me understand here, the risk of claiming early versus delaying it, and how do we determine when we actually start claiming this benefit?
Yeah, I think what plays into that's a great question. That's a question that we all have, is how do we optimize when we take it? And as I mentioned earlier, you can start taking Social Security at 62. Your full retirement age now for anybody born after 1960 is 67. And then you have to start claiming at age 70. So there are permanent reductions if you claim too soon. There are benefits and bonuses if you delay, right? They incentivize us to delay. So what are the risks? I think the risk of delaying is that you miss out of, several years worth of collecting some benefits. So I think that's psychologically it's money in hand, right? But the risk of filing early is that you lock in those permanently reduced benefits, which lower your lifetime benefits. And if you live longer, that really becomes a problematic when especially, as I kind of alluded to at the beginning here, is that, vast majority of people have, this is going to be their primary source of income. So if they claim too early and they live a good, healthy, long life, they are cutting themselves off. So that is a huge risk over that lifetime benefit. But there's no right or wrong answer. So let me run just a quick scenario, because I think the other issue is that fear of missing out. Right. So I kind of did an example here where if you're 62 today and you're afraid that the benefits are going to get cut in 9 years, right? In 2034, it may be sooner, as we've already explained. So let's just assume you're 62. Your starting benefit is, and we'll just for simplicity's sake, just say $4,000 a month. But if you claim early, that benefit will be cut. Well, you'll only get 70% of that. So your $4,000 benefit is now $2,800. Okay. Now you have a head start because you're collecting that money for 8 years potentially. So you're going to get a little over $300,000 of benefit, even though it's permanently reduced 30%. All right. So let's say in 2034, again, going back to my earlier assumption that if Congress doesn't act, they are now cutting benefits by 20%. So you're already 30% reduced benefit of $2,800 is now cut an additional 20%. Your benefit is now $2,240 a month. So let's accumulate those 8 years, and let's run that out to 20 years from now. So over the next 20 years, you're going to collect about $625,000 more or less. So let's take the opposite end of that spectrum. Let's say you waited until you were 70. Instead of getting 70% of that $4,000 benefit, you now get 124%, 8% a year. So that $4,000 benefit goes from $2,800 a month to $4,960 a month. Yes, you missed out on that cumulative income that you would have gained in the interim years. But now let's say again, under the same circumstances in 2034, you get a 20% reduction. Your 20% reduction is on a much higher number, right? So you go from $4,960 to $3,968 a month. The cumulative benefit, if you live to age 82, is about $630,000. So you're basically the same. So again, the risk is that deferred amount, taking that money early. And there are some other reasons why you probably don't want to, especially if you're working past 62, start claiming. But the benefit there is if you live past 82, you're basically giving up a lot more money, right? So it's that deferred, when you have kids, you get one marshmallow now, or if you wait, you get two. Most people will take the first, right? They want that instant gratification. As I said earlier, most Americans take the money too soon or suboptimally claiming. And only about 4% of Americans are optimally claiming their benefit. And that's leaving about $3.4 trillion that isn't that they could be claiming each year. So they're leaving a lot of money on the table, and the numbers, if you look at it, the earlier you can claim at 62, about a third of people start claiming then, and then it kind of tapers off, and then at their full retirement, about a third more. Only about 20% of people are delaying their credits, when in many cases you probably could and should delay those credits. One rule of thumb, Mark, I always look at it from this perspective. If you've seen a Social Security statement, Social Security is really three things. Remember, I told you OASDI, right? So the DI is a disability insurance. What was the S? What did the S stand for?
Social Security.
No, it's old age. That's your retirement benefit. Survivor benefit, right? There's a life insurance component to Social Security that people underestimate, right? So if you are a couple and you both claim too soon, right? You're going to, when the first of the two participants passes away, you lose one of those benefits. So the ideal situation is that, if you do claim early, you probably want to make sure the higher age earner delays as long as possible, right? Because the survivor, doesn't matter who survives, will jump into that higher benefit. Okay, so remember that it's three things: old age, survivor, and disability insurance, right? So what happens if you can't work? What happens when one of us dies? We have a life insurance benefit that we underestimate when we take those make those claiming decisions every year.
So it sounds like it's a circumstantial answer here, but
absolutely, there's no right or wrong, right? I mean, you have to go case by case, but in most cases, if the couple is healthy, I tell the spouse, because she's probably the one who's got the least savings and probably has the more likelihood of outliving the wife does, I should say, than the male. Don't let him get anywhere near the Social Security office until he's age 70, if they can. Now, again, health, individual circumstances, it's all case by case.
Interesting. I heard of one advisor would tell his real estate investor clients, because you don't pay Social Security on your real estate investments. He actually recommended hiring his spouse through a management company, or creating a management company to hire himself to create some ordinary income and actually pay the Social Security tax to pay into a future Social Security tax benefit, which is interesting because you see so much, in the tax planning world, so many people talking about how can we reduce our payroll and Social Security through S corps and other strategies. Here's an example where someone is actually trying to increase a tax because we're increasing our payment into the Social Security benefits.
Yeah, I like we said earlier, that there are good taxes, and that's probably one of the ones we should not feel bad about paying into, right? Because we're getting something back for that, right? So I applaud them for doing that, right? So there, again, like I said, sometimes increasing your income can benefit you in a lot of other ways, right? You get more QBI. You can do more Roth conversions and things of that nature, right? You got to be real careful, though. Again, you don't want to get into some phase out levels. So this is where hiring someone like you to help them monitor the intricacies matters.
So let's talk about, I'm going to ask you the top asked questions on this topic. You kind of touched on it earlier, but we're gonna get into just a foundational answer here. When can I start collecting Social Security?
62 is the earliest you can. Now, just because you can, we've already addressed, doesn't mean you should, right?
Now, this is going to be a loaded question, but I'm going to ask it anyways. How much will I receive in benefits from Social Security?
That depends, right? We do pay in a different amount, right? If you're a high wage earner, right, and your benefit is based on your highest 35 years of contributing, right? So as long as you have 10 years of contributing in, you are eligible on your own record. Okay, remember we've talked about some other benefits. We talked about a survivor benefit. There's also a spouse benefit, right? So that's something you also have to take into account, particularly for people who may not qualify based on their own record. There are spousal benefits, right? So there are a lot of intricacies on when to claim spousal benefits too, and when to claim the survivor benefits as well. So those are probably we do a webinar every year, and we get more into detail about those claiming strategies. But you got to be aware that those are out there. There's also benefits for divorced spouses are eligible for a spousal benefit, and widows, right? Divorced widows are still eligible. Again, there are certain rules and regulations around that. So that's a loaded question, Mark. And I think we have to come back and have another talk about all of the ins and outs and intricacies on those.
What is full retirement age?
Full retirement age for if you were born after 67 or 1960 is 67. If you were born before 1960, it was phased in. So most people who have were born in the 50s have already kind of reached or are reaching that full retirement age. So 67 is that full retirement age.
Will I pay taxes on my Social Security benefits?
We've already kind of addressed that, and the answer is yes. If you make more than a certain amount, if you're single, if you make over $32,000, I'm sorry, if you're single over $25,000, but up to $34,000, you're going to pay taxes on 50%. If you make over 34, you're going to pay taxes on 85% of that. Remember, that was the changes they made in 1983. For a married couple, it's 32 to 44,000. If you make over $44,000 a year, you're going to pay taxes on 85% of that. Okay, it's a complex formula, but you are going to pay taxes into, and that's going into that's not going into the general coffers. That's money that's going in to keep the system afloat. So we've already kind of addressed that earlier, and those were the numbers that were never indexed in 1983 that I alluded to earlier. So those numbers, again, I think there was a compromise. There's a solution out there of indexing those. So yes, the answer is you will pay taxes on your Social Security, and what the senior benefit in the OBBA, that does not impact Social Security, despite what anybody will tell you about it.
Can I continue working and still collect Social Security?
Yes, you can, but with a big but caveat there. Remember, Social Security is meant to be a retirement benefit. So remember, I told you the earliest you can apply is 62. But if I continue to work prior to my full retirement age and I apply for that Social Security, you will have what's called an earned income benefit reduction, right? For every dollar you make over a certain amount, they're going to withhold. For every $2, they'll withhold $1. And that number is pretty low for 2025. If you make over $23,400, they're going, every dollar you make, they're going to withhold 50 cents on that dollar, basically. So you may apply early, and all you're doing is permanently reducing that benefit, and you're not going to see 1 cent from it. Mm-hmm. So that's why I said be careful about applying too soon prior to retirement. Now, once you hit full retirement, there's no withholdings. You can collect those dollars. You can do whatever you want. So the main thing is to remember that full retirement age. That's the key. After that, all restrictions are off.
So, as you can see, the audience listening here, there are lots of variables going on here. And this is not something you want to do DIY, nor would you be able to properly plan for your Social Security by just plugging in some prompts into Chat GPT. You really want to work with someone who knows your situation, context, and who really knows how to best look at your whole financial picture, not only when it comes to tax planning, but planning for Social Security. So, Mike, if for the audience, I think one of the key takeaways here is before you even think about claiming any Social Security benefits at all, if I want to talk to you, what's the best way for someone to get in contact with you, and all, whether it's to use your services or just learn for you? What's a good call to action here?
They can certainly go to my webpage. It's www. My last name Skrynecki, SKRYNECKI FPG for financialplanninggroup.com. Just reach out to me. I'm happy to schedule a call. They can also email me at mike.skrynecki@raymondjames.com. I've got a schedule link. I'll respond. They can schedule, a quick call. We can go over. I do this all the time, trying to help people avoid making the mistakes. Again, the common mistakes are, critical mistakes sometimes is claiming too soon and kind of regretting that factors. Say, I have to, claim at 62 and then I go back to work, right? And all of a sudden, there are some very limited kind of ways to make up for that. But yeah, it is definitely one of those areas where, it doesn't pay to go it alone. And it certainly doesn't pay to listen to all the things that you hear on the webpage and listen, well, you need to do this, right? There is no 100% this is the way to do it. I always say, if you hear somebody giving investment advice at a cocktail party, give them my card. If you see somebody go act on that the next day, give them my cell phone number. So I've given you ways to contact me. I didn't give you my cell phone number, but hopefully we don't get to that point.
Absolutely. And to those of you guys listening, if you ever want to talk to how we do things, and when it comes to tax planning, and hopefully that tax planning will also give you opportunities to build tax-free wealth to help finance your retirement and achieve your goals, you can go to prosperalcpa.com/apply, prosper with an L, cpa.com/apply. Mike, thank you so much for this conversation. I think it's going to be really helpful, and it's going to really shed a light on a topic we haven't had a chance to really dive into. So this is very helpful, and really appreciate your time.
Well, let me give just one real quick plug, if I may. So I mentioned earlier, every spring we typically will do a webinar on Social Security. So next week on Monday the 15th, we're doing a webinar on Medicare. Okay, and Medicare open enrollment. Medicare starts at 65, not 67. So for anybody who is entering that arena, we can help with that Medicare planning as well. And even if you're on Medicare, Medicare is one of those things I always encourage people not to set and forget. The annual election period, just like when we work for somebody, usually is in the fall. The annual election period for Medicare is October 15th through December 17th. We're happy to do a Medicare review for you and, help you kind of navigate that system. Medicare and Social Security, most people don't know that, are both run in the same place. So you've got all of these people collecting Social Security, all these people doing Medicare. It's one agency that runs both of those programs. So they are not paid to give you advice. In fact, they're in Social Security, they're prohibited from giving advice. So most people are there just to help process that. And as we know, there are far fewer people. They cut a lot of the staff there, so the wait times are pretty long. So again, if you're interested in joining our webinar on Monday the 15th, September 15th, we do one every September. At 4:00, reach out to Mark or through the numbers, the address and the web address and email I gave you. We're happy for you to kind of join in on that as well.
Can we send a recording to the audience as well if they can't make it?
Absolutely, but they need to register. They do need to register for that beforehand so that we can send it to them.
All right, fantastic. All right, Mike, again, thank you so much for your time today.
All right, thank you, Mark. Thanks. Always a pleasure. Look forward to continuing the conversation.